What if I told you that $10 a day could eventually reach the point where your portfolio starts making your investments instead of your paycheck? Not because you became rich, not because you won the lottery, but because you gave every dollar a job and let time do what it does best. Today, I'm going to show you a simple concept using SPY, the State Street S&P 500 ETF, and SPY, which is the NEOS S&P 500 fund, that completely changed how I think about long-term investing. One thing I like about today's investing world is that fractional shares make it possible for almost anyone to start. When I was 18, there were no such thing as fractional shares or online brokerages. You had to buy full shares and actually had to go through a broker or a company to get them. So this does $10 a day. $5 goes to SPY for long-term growth. $5 goes to SPYI to begin building an income stream. This is SPY. Right now it's trading at $743.29. As you can see, it's a small dividend yield of 1.1%. It's not there for the dividend yield. But this is your 1-year growth. That is your 5-year growth. Averaged out, that's about 14.98%. Now, $10 a day is an amount many people may be able to work into their budget. It won't be possible for everyone, but for many people, it's small enough to become a habit. Because investing isn't about how much you invest. It's about building a system that can eventually work or without you. This is SPYI. This is the NEOS S&P 500 High Income ETF. It's trading now at $53.07. There's the dividend yield of 11.85. Now it pays dividends monthly, which means it's compounding monthly. This is its performance for 1 year. It is up 3.94%. It's only been around less than just about 3 years, so it's developing a track history. Now, I like to think of my portfolio as a sports team. Every player has a different job. SPYI's job is to grow. SPYI's job is to produce income. Neither one is trying to do the other's job. They're teammates. Imagine starting this at 18 years old. For years, your paycheck feeds both investments. Every day, $5 to growth, $5 to income. This is dribcalc.com. So this is nothing flashy, just consistency. This is SPY. I'm going to load that in. We're starting with 0. We're going to change that share price growth. We're just going to make it, we're not going to make it too aggressive. We're just going to go 8%. We're going to add 1825, which is $5 a day, 365 days a year. And we're going to add that yearly. We're going to do 30 years. And we're going to calculate. Eventually, those small investments start becoming something much bigger. But here's where this idea takes a surprise, interesting turn. Most people think the goal is to let SPY grow forever. I started asking a different question. What if SPY eventually starts helping fund SPY? So this is it here. As you can see, there you are at 10 years. But at 20, you have $103,042. Yes, you don't have a big annual dividend. At 20 years, you're only getting $688 a year. So I said I intentionally used an 8.8% annual appreciation assumption for SPY. So in this illustration, after about 25 years, SPY has grown to about $170,000. At that point, instead of continuing to contribute $5 a day to SPYI for my paycheck, and we're going to hold on to it for a second there because we're going to go to SPYI, load, do that same thing because we're starting with 0. We're adding the same 1825. And we're doing that same thing for 30 years. We're going to calculate. So that's it. I could theoretically move about that $1,825 per year, the same as $5 a day from SPY into SPYI. The annual transfer is only a small percentage of the overall SPY position in this example. The goal isn't to predict the future. The goal is to show how a growth portfolio can eventually help fund an income portfolio. If you're enjoying this different way of thinking about investing, hit the like button and subscribe. On this channel, we focus on giving every dollar a job and building wealth one small investment at a time. As you can see, well, we've done something wrong here yearly. Let's recalculate because it's not growing that much. But at 20 years in SPYI, you now have $227,000 and you're getting a nice chunk of change for your annual dividend. You're just about $27,000 a year. So you get $26,968. Now think about someone who starts at 18. At about 43 in this illustration, 25 years in, SPY could potentially begin helping fund SPY. You don't have to take that $5 a day and put it into SPY. You could take it out of SPY and put it into SPYI. But what if they don't need to make that transition until age 50? If you go to where you're 48, which is 5 more years, you're already at just about $1 million in SPYI, and you're collecting a nice $131,180 in dividends at that point. So now SPY has had another 7 years to compound, and let's go back to SPY. SPY. $1,825. And no, we're going to go 30 years. And there you are, because at 30 years into SPY, you have $805,391. You're still not collecting anything major in terms of dividends. You're only collecting just about $11,677. But you could start moving money over from SPY to fund SPYI for your long-term retirement. It could even become a generational wealth. That's a possibility. Time isn't so. Assuming positive long-term growth, that same 1825 becomes an even smaller percentage of that portfolio. You're taking 1825 a year out of SPY to fund SPYI. Time isn't just growing your money. Time is making the transfer potentially easier. And here's the part I think most people miss. The goal isn't just to retire. The goal is to build a portfolio that eventually starts taking over jobs your paycheck used to do. In the beginning, your paycheck feeds both investments. Eventually, your growth portfolio may begin feeding your income portfolio. And later, your income portfolio may begin helping support your lifestyle. That's why I always say every dollar has a job. The jobs just change over time. Now, this video is for educational and entertainment purposes only. It should not be considered financial advice. I'm not a financial advisor, and the returns and examples shown here are hypothetical illustrations. Actual market performance will be different, and past performance does not guarantee future results. Always do your own research and invest according to your own financial situations and goals, and do consult a financial advisor. So speaking of jobs, my next video is about something that might surprise you. Well, so I believe that just like believing that your portfolio is like a sports team, I believe that you are the coach and general manager of your portfolio. You sign your players, your investments. You give them jobs to do. You set their plays. You give them what they need to do to perform, and you watch them and you help them grow. You help put them in the right positions to do their jobs, and you fire them, trade them away if they don't work, bring in new ones. So where every investment has a role, every dollar has a job, and sometimes the best move isn't adding a new player. It's just putting the right one in the right position. But if you stick around, I have this video here talking about how my 20-year-old self would absolutely hate my current portfolio, and I'll explain exactly why. Thank you for watching, and we'll see you in the next one.